Hello and welcome to What Goes Up, a weekly markets podcast. My name is Mike Regan. I'm a senior editor at Bloomberg.
And I'm Vildana, Hajric, a cross-asset reporter with Bloomberg.
And this week on the show, well, after a rough 2022, some of last year's worst hit investments, from tech companies to meme stocks, even Bitcoin, have gotten off to a roaring start to the year. So is this rebound finally the one that's going to stick, or is it just another head fake? We'll get into it with the co-chief investment officer at a wealth management firm. But Vildana, before we get into it, I gotta apologize.
For
I'm going to be cranky for this episode.
Why?
Because I made the mistake of stepping on a scale on Monday.
I knew you were going to say.
How'd you know that?
I had a feeling. I can intuit.
You just looking at me, you could tell that stepping on a scale is not going to bring me joy. This time
No, it's not that. It's because I gave you a gift. I bought you this like special hard to find dip that I really like.
That's right.
And I asked you if you like it, and you said, it's good, which means that you didn't like it and you weren't eating it.
No.
But had you tried it,
no,
there's no way you wouldn't have liked it.
Well, why would I be mad at the scale if I didn't like it, though? I got you there.
Yeah. Joe Weisenthal did a 3-day fast the other day. Did you know that?
I think it's like 4 days. I can do like a 4-hour fast at
me
most.
Too.
Yeah, that's about it.
I just ate 5 minutes ago.
But the lesson is never step on a scale in January, I think.
Just in general, who cares? Don't step on it.
Well, let's put the markets on the scale here. How about that?
Oh, that's good. That's a really good transition. I do want to bring in our guest, Keith Lerner, co-chief investment officer at Truist Wealth. Keith, thanks so much for joining us.
Yeah, great to be with you, Vildana. It's so great to be on the podcast. I know you and I have spoken for several years, so this is just a great setup. And Mike, great to meet you as well.
Yeah, Keith, why don't we start off, just give us a little bit about your background and the background of Truist. Now, for listeners who aren't familiar, Truist was formed basically by the merger of SunTrust and BB&T a couple of years ago. Is that right?
That's right. Right before the pandemic, we merged, and we're the 6th largest bank in the country. Big presence in the Southeast. Also, you might see these big purple signs up in the Northeast as well, like New York and California. So we're really across the country at this point. And we have a very vibrant and growing wealth business, which I am fortunate to be the co-chief investment officer and lead our asset allocation, market views, economic views, and really helping our clients navigate these complicated markets.
And I think, Vildana, our first guest in the city of Atlanta. How about that? Is that true?
Is that true?
I don't know.
Is that true?
I think it might be true.
Is it true?
It's Truist, yes. Well done.
I love a good pun. Okay, so maybe wild or weird or crazy markets is maybe even an understatement. So Mike mentioned that we are seeing this resurgence in meme stocks, in crypto, et cetera, et cetera. Maybe can you just talk about what's behind this sudden new interest in stocks as we turn the page onto 2023 and as the year is getting started?
Sure, and I think at the onset you mentioned, hey, is this something the beginning of something that's sustainable? And we're skeptical. You said also turning the corner, I think, or maybe the calendar, and I think that's what's happened. If you think about late last year, we saw actually a lot of tax loss selling. We saw the market, the S&P, have this kind of correction in December around 5 or 6%. So I think as you turn the calendar, a lot of these areas that were beat up, that were sold off late last year, are seeing this mean reversion. And January is often the time when you see that mean reversion. I would say this, if you think about the meme stocks, those typically will do well in a period of rising liquidity, and we're still taking away liquidity. So we just don't think it's sustainable. We think it's more of a bounce, but we would be fading that bounce.
Keith, I know in your outlook for 2023, you talk about the need to remain defensive. What does that mean in this environment? The notion of defense, to me, I think it kind of changes with the times. For a while there, it felt like big cap tech was defensive, during the pandemic. What's a good defensive strategy look like these days?
Sure. And, we moved to an underweight position in equities at the end of October, and we went to an overweight position in fixed income. And as we're thinking about kind of big picture asset allocation, we think that the macro risks are large. We think there's still somewhat elevated recession risk. And we look at, equities and credit, we just don't think you're being compensated. At best, you could say with the correction we had last year, equities are maybe fairly valued. Credit markets are actually, to us, very expensive relative to the risk. So being defensive from a stock, bonds, and cash perspective is being overweight fixed income relative to equities. And then in the fixed income component, keeping it simple, keeping it with high quality fixed income and not really taking a lot of credit risk at this point. And then more kind of moving down a little bit, Mike, when we think about the overall markets, I think you also have to go below the market's surface. As you mentioned, tech is still not leadership. So we've been seeing more opportunities below the market's surface, things like the equal-weighted S&P. And then lastly, more of on a sector standpoint, barbelling kind of defensive sectors like healthcare with things like energy and industrials that have some unique circumstances, in this environment.
So Keith, just going with that defensive theme, I think you are also foreseeing a U.S. recession this year, right? Whereas we've had some people coming out recently and being maybe a bit more optimistic or saying that any potential recession is likely to be pushed back or delayed. So tell us about what you're projecting for the economy.
Sure, and I think we all know if we do have a recession, it'll be the most called one beforehand in history. But listen, we follow the weight of the evidence, and we look at some timely indicators, and those indicators, whether it's the deep inversion of the yield curve, the leading economic indicators, which are down more than 4% on a year-over-year basis, housing market, which peaked last year, those historically suggest elevated recession risk. But, as we look even at the yield curve, when you say, okay, on average, once you invert, which happened last year, that would push us more into the middle to the fall of this year. So, as far as the recession, I would say right now, the data suggests we are not in recession, but we still think there's risk of one happening later this year. And I think the biggest reason behind that is, as we all know, as we've all been talking about the last year, we've had the most aggressive increase in monetary policy, not only domestically, but also globally in the last 40 years. And we just think that's going to weigh on growth as we move further into this year.
Keith, one theme I keep hearing people talk about a lot this year is the outperformance of the rest of the world versus the U.S. And I'm looking at some of your positioning advice here. You rank international developed equity markets and emerging markets as sort of the less attractive side there, which I find interesting because there does seem to be a lot of bullishness elsewhere towards, the rest of the world, excluding the U.S. So walk us through what you're seeing that makes you sort of want to stay away from international equities.
Sure, and maybe a little context. I mean, we've been big bulls on the U.S. for several years. Fortunately, have benefited from the big outperformance because we've been thinking the U.S. is that big blue chip country. And if you look at it just kind of simply, the earning trends for the U.S. have been so much stronger than the rest of the globe. International markets have done really well. And if you think about why that is, I think there's two main factors. One, the climate in Europe was much warmer than expected. So the energy crisis that a lot of folks were concerned about just didn't happen. So that's one positive. And then the second positive, which was unexpected, was basically China ripping the Band-Aid off of COVID. And Europe's a big trading partner. So with all that said, listen, I think that's an area we're focusing on right now. On a short-term basis, if you look at the last 2 or 3 months, it's had one of the biggest outperformance periods in the last 20 or 30 years. So our position is things are getting more interesting there. You've had a big run because of these unexpected events that have broken the right way. We would be looking more potentially to upgrade that on a consolidation or a pullback after such a strong move up that we've seen. But again, in the grand scheme, the last 10 years, it's really still underperformed by a wide margin.
Is that part of being more defensive too, is leaning more towards U.S. than international?
Traditionally, yes, but I would say, we are somewhat and been underweight tech for several months. So it's not just as simple as saying, hey, buy the S&P 500. We've been a big advocate over the last year and still are of the equal-weighted S&P, which basically is a proxy for the average stock. It's not weighed down so much by these big mega cap tech stocks, and the valuations are more reasonable. If you look at a relative price chart, you're basically at a 4-year relative high to the overall market. So it's almost like a period. It's an echo of 2000 where you want to start looking different, and we've been doing that over the last year, than just the S&P 500. It's not just buying that index and sitting back, because we just don't see tech as leadership, likely even for the next cycle.
Okay, tell us more about your preference for the equal weight index, because it has been outperforming over the last couple of weeks. And basically what that shows us is that the rally has been more broad-based than previously, right?
Correct. And as I mentioned, we really started getting more interested, early last year when tech valuations got pretty expensive. And the way to think about it is tech, communications, and growth, their allocation within the S&P became so large. And we all know about the FANG stocks and how large each of those individual companies. So what we're seeing is this kind of reallocation from these really heavyweight growth areas to these smaller weight, value, cyclical areas of the market, and even some of the defensive areas. So we're seeing this rotation, and we just expect that's likely to continue. And unlike, big cap tech, which has corrected a lot, but still, I would say, is not cheap from a historical standpoint, the average stock is trading close to about a 15 times multiple. Again, I'm not saying that's deeply cheap, but it's more reasonable also from that perspective as well.
Yeah, Keith, one note of yours that caught my eye, you call it the reverse Tepper trade. Presumably David Tepper. Is this betting against the Carolina Panthers? Is that what this trade's all about?
Who isn't betting against them?
I assume that's not it, but talk to us what it really is.
Yeah, I have some relatives in Charlotte, some in-laws, and also now our headquarters for Truist is in Charlotte. So I'm not going to be rooting against them, but that's not going to gain me any
any fans,
new clients in the
exactly. So the way we put this note out mid last year, which was interesting. I saw him probably about a week after we put this note out, and he basically validated our view. I did send an email to David and said, "Hey, FYI, we sent this out. I haven't heard back, so maybe he'll listen to your podcast and shoot me an email." But the way we're thinking about it is this: if you remember back, coming out of the financial crisis I think it was around 2010. Back then, David Tepper made a very cogent point. It was very simple. He said basically, either the economy is going to get better, and that's going to help stocks out, or the economy is going to weaken, and the Fed's going to step in and support the market. So it's almost like a win-win proposition. So in some ways, you have almost a polar opposite of that today. And this goes back to the whole question about recession or not. Is one, either the economy is going to stay somewhat strong, and that's going to force the Fed to continue to be somewhat tight, or the economy is going to weaken, which is going to hit corporate profits. And if you're trading at a 17.5 multiple, there's some downside risk. To be fair, there is a third scenario, which the market has started to buy into a little bit, is this kind of soft landing where the economy, slows down but doesn't go into recession. Inflation's coming down rapidly. And there is some probability. We just don't think it's a high probability. And that's one of the reasons overall why we still remain defensive, because you're just not being compensated for the macro risk that we're seeing, at least not today.
I wanted to ask you, speaking of the Fed, how the recent rally in stocks actually works against the Fed's goals, right? So we have a loosening of financial conditions, and it's not exactly like the Fed wants to be seeing stocks rallying.
That's right. And I mean, it's not just the equity market. Also, you look at the credit markets. I mean, look, high yield spreads are back to where they were several months ago. So really not embedding any recession risk as a whole. And I think if you're the Fed and you're focused on financial conditions, which you can impact, I think at some point they're going to start jawboning the market again. So I think that's a challenge. And then also, the unemployment rate, if you're in the soft landing camp, the unemployment rate is still at 3.5%. I mean, that's not a place where, even if you see disinflationary trends, that we think the Fed's going to take their foot off the pedal, at least on the jawboning side. And we also think the Fed has some scar tissue from what's happened over the last year, which will make them maybe not as aggressive when they do eventually pivot.
So talk us through what you're thinking from the Fed. This week we did get some new inflation data. The PPI index, I think it was down 0.5 percentage point month over month. At the same time, we saw downward surprise in retail sales, down more than 1%. Some of the regional Fed indexes have been pretty bad. Is this enough to make the Fed at least pause after maybe another 50 basis points, or what? How do you see it all playing out in sort of the first half of the year with the Fed?
Yeah, I think in general, they probably should be somewhat happy. It does look like we're seeing disinflationary pressures. CPI looks like it did come down. The rents we all know is going to work with a lag. So I think they should be, probably the PPI, as you mentioned, I think overall they'll be happy that things are moving in the right directions. But even if they are going to pivot, I don't think they're going to let you know. There's no reason for them to really, talk too much about taken their foot off the pedal, even though it's more likely, to the point, is probably another 50 basis points or so to go, and then just a pause and then just a hold. And going back to the premise of scar tissue, this is something we started talking about a lot last year, is that, for over, 2 decades, the Fed really didn't have to worry about inflation, right? If you think about coming out of the financial crisis or the printing back then, which actually looked small relative to the last couple of years, there was all this discussion about inflation. It never came. So that really gave the Fed the green light to come in at any point to support the market. Well, this is the first time in decades they've had to worry about inflation. So we think that scar tissue of what's happened over the last year is going to make them more reluctant to be aggressive. And I think one of the things, if we do have a recession, which again is our base case, I think there's a lot of discussion, is this going to be hard or soft? I think a lot of the things like the labor market, low delinquency rates suggest maybe, somewhat short and shallow. But I think the risk is there's just not much of a policy response relative to the past if we have some type of outlier event, and that's the risk.
What about this idea that the reopening in China can complicate what the Fed is trying to do, in that with their reopening, we could maybe see a resurgence in inflation numbers here in the U.S.? I'm wondering about that, and also how maybe whatever is going on with China might complicate your outlook as well.
Yeah, no, and that's the thing. You can look back at history. There's a historical playbook. But, the historical playbook's likely challenged because, how many times did we have most of the globe slowing and then the second largest economy actually stimulating and also showing economic growth, which is certainly likely to be much higher than the past year in China with the stimulus. So to your point, I do think if as China reopens, that likely puts some upward pressure on commodities, or at least support. Maybe it won't go down as much as typical. And that's where I think the main translation could be for the Fed, is if some of these commodity prices stay higher for longer because of that. I will say, just like what we experienced here in the U.S., a lot of, I think what you're going to see is more of kind of this pent-up consumer spending, especially on the service side. Vildana, I saw a stat this week. You think about them reopening. I haven't verified it, but it came from a legitimate source, as I recall, is that in 2019, tourism from China to Europe, I want to say the amount of nights stayed from Chinese tourists in Europe was like 20 million. And then in 2021, that fell to about 1.5 million. Again, 20 million plus to 1.5 million. And that was at the end of 2021. We don't even have the stats for the last year. So if they just go back to half and start traveling, and I'm sure there's a lot of folks that are antsy to start traveling again, that's huge. That's huge demand. And probably one of the reasons, going back to the question about international, you've seen this really V-shaped rebound in international markets.
Yeah, probably be good for the euro too, I would assume. Get a rebound there too. Keith, I know one thing you said in your outlook is you need to remain tactical this year. So I'm curious what sort of signs it would take, or what sort of market action you would need to see to get you in the bullish camp of things. What is there any sort of target you have for the market, or something that would make you go, now's the time to really jump in with both feet into stocks, into growth, into, all these things we're kind of shirking at the moment?
Sure. And, we don't have specific price targets. We really find it more helpful to have kind of conditions and then, use the weight of the evidence. So a lot of times when we say be tactical, like last year, as I mentioned, we had 6 moves of at least 10% in the market, right? 3 to the downside, 3 to the upside. So I think as this whole debate rages on about hard landing, soft landing, China reopening, Europe, I think we're going to have those tactical opportunities as well. So things that we'd be looking for, I guess, to take money off the table, like maybe start there is, we combine, valuations. So like if you think about this market, an 18 PE has been kind of a, top end of the range, even before the pandemic, around 18.5. And then you look at some technical things, like even with the recent rally, we were now the most overbought we've been for a few months. So to us, the risk reward is not that compelling as you kind of move from 4,000, 4,100. To the other side, more direct to your question, what gets more positive? Probably lower prices and sentiment that gets a bit washed out more, and cheaper valuation. So, and when we think back around October, we were around 3,500 or so, trading around the 15 multiple. Sentiment very negative, and we saw our technical indicators very oversold. That's the same thing that we're looking for. And I think, listen, we're not trying to top bottom tick each of these. It's impossible. But our focus is there's going to be these extremes. And when we start to see those conditions move to an extreme, we want to be tactical to add risk or take risk off. So I would say maybe the point now, I mean, if we get back closer to those lows, to us, that would be more interesting, where today we just don't think things are that compelling relative to the risk.
So you mentioned the overbought conditions, and you are somebody who pays a lot of attention to technical indicators and technical signals. So I want to ask you what specifically you're paying attention to these days, given the rally that we've seen, broadly speaking, and how important may be something like the 200-day moving averages for the S&P 500, which I believe we failed to break out above once again. I think it was the fourth or fifth time over the past year that we failed to do that.
Sure, and sometimes, as we look at fundamentals and technicals, sometimes they conflict and sometimes they're in alignment. Obviously, the high probability outcomes are when they're more aligned. I will say there's kind of mixed readings. The 200-day moving average, it's more just a reflection of trend, and we've seen that the market got above it, below it. I really think the 4,100 level is probably the more key level near term from a technical level. If you were able to get above that, I think that would, the technical trends would improve. But so far we've failed there. So that's something to kind of keep an eye on. And then, again, if we can combine the 4,100 level and we say, okay, what multiple are you at that level? And say, okay, you'd be around almost an 18. You kind of combine those things. To me, that's more powerful. It's something that in the technical community, in which I follow a lot, is we certainly have gotten some things of what's called these kind of breadth thrusts. We've had earlier this year, we've had a lot of participation. And when you have a lot of participation, especially over a 10-day period, historically you have these signals that are called breadth thrusts, where you have more of a 2-to-1 ratio of advancing to declining stocks over a period. And when you test that out, looking at a year, they have a high probability of success. And actually, as you come out of a market downturn, you want to see really strong breadth. You want to see the market get very extended overbought. But I will say what's tricky this time is we had a couple of thrusts last year that failed. And this is indicators I've been using since the 1990s, and it's had a 95% plus beat rate or positive rate, and we had two that failed. So at this point, I think it's encouraging that we've seen some of that because of the macro condition, because of where the valuations are. It keeps us somewhat more skeptical. The other thing that I think you want to look at is just, where's the leadership? And right now, if you go sector by sector in this market, it's hard really to see where the leadership is. Tech made a relative low at the end of last year. It's bounced back, so okay. Communications bounced back from an oversold condition. Financials were doing a bit better, but now kind of giving some of that back. Defensive, which we've been more positive on, they're kind of mixed. So what I'm looking for is, will the real sector leadership please stand up? Because you just have a lack of that right now, more broadly, as far as what I'm looking at.
Do you think it'd be more of a factor leadership, value over growth, something like that?
Yeah, I mean, I do think it makes sense. It seems like there's more of a consensus view that value should outperform. We are overweight value, and part of the reason why we're overweight value is you had also, a decade of underperformance, and we're skeptical that technology, after the big gains it's had over the last decade, regains leadership. So we still like areas that have some unique things like industrials, think about reshoring. There's a lot of discussion about the defense spending domestically, but think about over in Europe as far as the rising defense spending over time, or even our strategic, battle with China. Like there's probably going to be more, the defense spending over time secularly. So we still like that. Yeah. So again, that would kind of lead you more towards a value tilt relative to growth.
Mike, I have to call you out.
About overweight?
No. Oh my gosh, no. You just
keeps talking about being overweight.
You skipped right over Keith's M&M reference.
Oh, you're right.
Yeah,
I was hoping
that was good.
That.
I caught it. Of course I did.
Hey, Vildana, I want to share something with you. What I did today in Chat GPT, which is, I guess, the buzz right now, right?
Yeah.
I did a search for 80s style rap with the Federal Reserve, and I was very impressed with what came back. So it put together a rap song for me. I just need a chorus, and I was going to ask, since you are all so good on these podcasts, maybe Mike and you could join the chorus with me.
Oh my gosh. You need to send
I'll do
whatever
the beatbox.
Yeah, whatever lyrics it came up with, you need to send them to us.
I think Keith wants to rap. I think
I think he does. You'll have to.
He's dying to rap. Here.
You'll have to come back next week with the whole song wrapped up.
Okay.
Yeah, you need to share this with us.
Absolutely.
We'll tweet it.
I didn't know ChatGPT went gangster like that. That's interesting.
Wow.
That's,
It's funny.
Even the rappers are in trouble, I guess.
Honestly, I would be a little bit nervous if you saw this, the lyrics that he came up with, because over the weekend, I was talking to one of my colleagues, and I was saying, well, let's see if ChatGPT can tell me what happens to the market after it's down. And he's like, oh, you're using it wrong. You can basically ask it to develop a poem or a love letter to your significant other. I'm like, okay. So it's pretty impressive.
I can't wait to see this. This will be good.
It's impressive and scary. For people in our business, it's very scary if market stories can be written by a robot.
Yeah.
But Keith, let's move over to the fundamental side for a minute, because I feel like just about everyone I've talked to recently does not believe the earnings estimates that we're looking at for 2023, almost to a person, especially the top-down people such as yourself think, no way do we get, any sort of positive earnings growth this year. I think Savita Subramanian last week on the show talking about a 10% drop in earnings, which I feel like would be a pretty ugly outcome for this market if they sniff that type of outcome coming for the whole year. How are you thinking about earnings? We've gotten that first trickle of earnings. A lot of the banks, a few other companies starting to get more into the industrials and whatnot. Anything pop out for this reporting season, and especially how you're thinking about the whole year as far as earnings growth or lack thereof?
Sure. And maybe before I go specifically to earnings, I think even if you have a view that earnings are going to be stable and that the forward earning estimates for this year, which is around 230 for the S&P, is the right earning estimates, which we're skeptical of. Even at that, you're still trading at around the 17.5 multiple. So now if you think that there's earnings risk, which we do, then the PE multiple is actually above that. So I think in this point, again, thinking about risk reward, I think right now, even using that, it's just not that favorable on that. But going specifically to your question, one thing we look at is trend earnings over a cycle. And when we do that and we look at trend earnings, that does bring us to a number, closer to 200 for the S&P. Whether that happens, by the end of this year or early into next year, is debatable. But I think there's more downside. And historically around recessions, as most of us know, is that earnings go down about 20%. I think that's a bit severe. I think companies have done a tremendous job of handling this downturn. And, so I think something in the 10%, haircut is more reasonable to expect. But again, if you apply that haircut and you look at market valuations, you're just not that attractive, especially relative to where yields are. The yields are about, not anymore. They were almost double the 10-year average, but they've obviously pulled back here, the last few weeks.
And Mike mentioned we've already heard from some of the banks, and some of the earnings reports have started to trickle out. So from what we've seen so far, has stood out to you in terms of any big themes or any worrying signals?
Honestly, it's a bit premature. I mean, we had the financials. It was mixed. You saw, differences from, if folks businesses that depend on investment banking and trading versus wealth management. So I don't know if there's a big read there. I will say going into this earnings season, there were a lot of estimate cuts. What I'm really be focused on as we get more broad earnings that get a better tell is what's happening on the inflation side, and also we're starting to see consumers push back a bit more, right? So that's going to hurt margins. Margins are still near record levels. They've come down some, but also where those margins are. But again, I think it's a bit premature to have a good feel. I expect that it will be somewhat of a mixed earnings period, and we're going to start to show more weakness in the quarters ahead as the economy shows more substantial weakening that what we've seen. Because if you look at Atlanta GDP now and some of these things, the overall economy is still held in there pretty decently into the fourth quarter.
That's what guys in Atlanta look at the Atlanta GDP now.
They have to.
Did you see that shout out? Yes.
I think if I'm not mistaken, your Bills might play a playoff game in Atlanta. Isn't that true?
if all goes right, hello. Knock on all the wood all around you.
So you'll get a playoff game after all, Keith. That's
we look forward to it.
That's not the one anyone was.
What a diplomatic answer, yeah.
Well, Keith, just to wrap things up here, one thing about and it's not necessarily your earnings season itself that's bringing it out, but just coincidentally is seen some really sort of alarming job layoff announcements. We're recording here on Wednesday. Microsoft just announced 10,000 layoffs. Amazon, I think, announced something like 18,000. We've seen the banks, a lot of some layoffs, more than your typical culling of the flock at Goldman, that sort of thing. Yet we still have this just off the charts number of job openings, near record low unemployment. How do you see that all playing out? Is it a matter of there's, people losing good high-end tech jobs and picking up the slack on the low end, the service jobs that are available, and it sort of becomes a wash, but a much lower paying sort of job for some of these people that get laid off? Or how do you see it playing out from a macro perspective? It certainly, job cuts can be sadly be good news for a company's individual share price, but I wonder at what point we have to start worrying about it from the macro level as far as the signal it's sending.
Sure, and you're right. I mean, this just goes to the kind of the complexity of not only the market but the economy. I think the high-profile tech job layoffs that you're seeing, I think that's a function that there was so much demand that was brought forward. If you look at Microsoft and Meta and Amazon, look at where their job levels, employment levels were in 2019, and then compare it where it is now. I mean, in some of these areas, we're 40, 50% above. So if you look back now, based on, that kind of pull forward, the oversupplied of workers. So I still think we'll see a reallocation. There was, I think there was a Wall Street Journal article last week that discussed that these tech folks that are being laid off, the good news is they're finding other jobs relatively quickly. The service side still seems relatively strong. We're seeing that in some of the airlines, and if anyone goes to a restaurant out, it still seems somewhat buoyant. But I do think as we move later in the year, probably by mid-year, I think you'll start to see that pick up to more levels. It's somewhat higher levels, I should say, because initial jobless claims, even though we see these big headlines, has still been, pretty low by historical standards. But we do think that's going to eventually start to move up. And it's important to remember that the job market is like the most lagging indicator that we have, right? It's one of the last things to turn before a recession as well. So that's also, I think, causing some confusion.
Keith Lerner of Truist, great to get your thoughts on the market. Hope we can have you back again one day. But
with that wrap.
And with your wrap, yeah. We need a rap name. We got to get him a rap name.
Let me think about it.
We'll think about that for a while.
Yeah.
Vildana, help me out. You all are good at making something sound better than it is, right?
That's why she's my partner.
You're up to the challenge, I think.
A lot of good rap out of Atlanta, so he's
that's true.
Right.
He's coming from a good pedigree down there. But Keith, we can't let you go until we hear the craziest thing you heard from markets this week. But since Vildana's bragging about having 3 or 2 or however many,
I have 2.
Why don't you start?
I have 2.
All right.
I'm melding them together into one theme.
Okay. All right.
Which is that formerly, maybe we can call them disgraced crypto people.
Okay.
Making a comeback this week.
Oh,
This is
another
the big
rapper.
Crypto comeback. Yes, another rapper. So one is Heather Morgan, also known as the Crocodile of Wall Street.
Razzle Khan.
Razzle Khan. Yes, that's right, is her rap name. So she was infamous for her rap videos and rap songs and for stealing a few
billion worth of allegedly of Bitcoin, right?
4.5 billion worth of Bitcoin from Bitfinex. So the story this week is that she was offered a job at a tech company in the role, this is a quote from the story, in the role of growth, marketing, and business development specialist.
So how bad can the tech job market really be when someone out on bail for allegedly having a few billion in stolen Bitcoin?
She's on house arrest, and I think that they asked the judge to okay her going to the office.
I would love to hear her bosses explain.
Me too. We don't know which tech company. Yes. I have another one, though.
Okay.
You remember the 2 co-founders of 3AC?
Yep. Yep.
So that's the crypto hedge fund that blew up last June. So the two of them, Suzu and Kyle Davies, they're looking to raise $25 million for a new venture, which is a crypto exchange.
Oh, boy.
They're looking to do it ASAP. And the name that they had on the pitch decks was GTX, which sounds very, very similar to FTX.
GTX. What's it stand? Did they say
G comes after F.
Oh, it's just the next.
The next letter.
Next episode, as they say.
Yep. F
Wow.
plus one is
I
what.
bet they get it too. I'm going to go out on a limb and say that they raised that money, probably from Razzle Khan herself.
Possibly, yeah.
All right, Keith. Vildana came prepared. How about you? You see anything crazy recently in markets?
I don't think it's as fun as what Vildana has. But I was thinking more kind of interesting from a market perspective, which we touched on, is that the European banks have ripped up 40%, and we have a lot of these FANG and technology stocks down 40 or 50%. And as you think about the last decade before the pandemic, it was all about low rates, paying a premium for growth, and probably the most hated asset out there was these European banks that got hurt from all those things. So it's interesting that we're seeing now, a period of QT, somewhat higher interest rates, somewhat higher inflation, and these European banks, the unloved asset, which have a lot of problems, by the way, still ripping and outperforming. So that was one not as cool as Vildana's, and maybe just one follow up to, because I need two to have, and this is not that fun, but I think another thing that came out recently. And I think we saw this with the UN talking about China's population over the next century will decline by about 600 million. And I think we most of us probably saw that headline, but to put that in perspective, that's 2 times the population of the U.S. almost. That decline. So those are my two. But again, I really feel like that was a tough follow up to that.
No, don't.
Those are good. Mine are better.
Don't sell yourself short. A 40% rally in European banks. If you had told anyone that a few years ago, I think they would agree that's the craziest thing anyone's seen. Pretty good. All right, I'll give you mine. I'm dipping back into the alternative asset class that I love so much. Kobe Bryant's jersey. Mm-hmm. Listing on Sotheby's up for auction. So this is one of the jerseys he wore in the 2007-2008 season. He was MVP. They went to the finals, and I think they got beat by Boston. I'd have to double check that. And I got the story. It's a CNBC story, courtesy of the Twitter handle @Zalvani, a new contributor to the craziest thing. So we thank him. To me, what the expected price for this jersey is not the interesting part of it. They think it'll go for as much as $7 million.
Okay, that's what I was going to guess.
It's of course you were. Which they say will be the highest priced piece of Kobe Bryant memorabilia ever to go up. To me, the interesting thing is how many times Kobe Bryant wore this jersey in a game. So to play the prices precise, Keith, you two are going to have to tell me how many times you think he wore this jersey. It's a home jersey. And I'll give you some stats here that might help you out.
Okay.
82 games, regular season games in the NBA, plus another about 21 playoff and finals games. So call it 100 and change games. Home jersey, so he'd be wearing a home jersey at approximately, call it 50 games in the season. How many times do you think he wore this particular jersey in a game? And it's surprising to me.
Do you want to have Keith go first?
Keith, what do you think?
Are we playing by the price is right, because then she gets the advantage?
Yes, but it's called the price is precise, not the price is right.
So
okay.
I'll happily go first because I have an answer.
You go first.
I'm going to say once.
You're going to say once.
He wore it once. Like, why would he wear it again? He's
he has
the
MVP,
a million.
Right? He's not like some journeyman signed from the Euro League or something.
He had so many jerseys.
He's wearing a new jersey every night.
Yeah,
right?
Exactly.
Right.
I'm going with once.
Right.
I'm gonna go on the other side then. I'm gonna go 50. I'm gonna say he wore that shirt every single day. She's gonna say once. I'm gonna say every single day he slept with that shirt.
Wait, I think we got a push. It's 25 times he wore this jersey.
Wow.
Which to me was surprising on the high side. I'm with you. I would think
one.
I'm Kobe
Twice.
Bryant. I'm going to wear a new jersey
Every time.
every night. I'm going to auction the used jersey off.
Yeah.
So
Or throw it in the stands.
half the games, he wore the same jersey. I think that's crazy. I don't know.
Sure.
Surprising.
Do I win?
I think you win.
Yeah,
No.
I win. Keith went way over.
Oh, man, Keith.
He went way over.
Keith, you could have won. You knew the Price is Right rules, too.
You know, I figured if I gave that, maybe you all will have me back on at some point.
Well, we have to have you back on for the wrap.
Yeah. Well, and Vildana's never going to let you live this down, by the way.
No, never. Every time we talk going forward, I'm going to
If
bring
I'm
this up.
Kobe Bryant, I'm not wearing the same jersey 25 times.
Not a chance.
Mean, you'd think there's be blood on it. It'd be all sweaty. I don't know. I
Smell
don't
it.
get it.
Mike, you are no Kobe Bryant.
That's true. That's true. Maybe that explains it. It was his lucky jersey.
That's funny.
He's seen me play, unfortunately.
Me and you both.
I did. I grew up right down the street from him, basically. He was Lower Merion. I was Westchester.
Oh, really? I didn't know that.
Yeah, that's about where the comparisons.
Yeah, that's it.
Keith Lerner, great to have you. You could have won that one, man. I don't know. Learn your lesson. Always go for the jugular.
Learner,
in the
your lesson.
Learner, your lesson. Paul, you're full of them today.
Well, I'm going to hear that from my friends now. Thanks a lot.
Great to catch up with you, Keith. We hope we can get you back.
Yeah, it's been a lot of fun. Thanks so much for having me.
Thanks, Keith.
What Goes Up will be back next week. Until then, you can find us on the Bloomberg terminal, website, and app, or wherever you get your podcasts. We'd love it if you took the time to rate and review the show on Apple Podcasts so more listeners can find us. And you can find us on Twitter. Follow me at Regan Anonymous. Vildana Hajric is at Vildana Hajric. You can also follow Bloomberg Podcasts at Podcasts. What Goes Up is produced by Stacey Wong. Thanks for listening. See you next time.